Hello Proponomics people, and welcome to this week's 4 pillars of investment video, and this one is about the financial pillar. So just to recap, the 4 pillars is a strategic framework I've been putting together since 2016. It's a work in progress, and it's the way that I've been able to visualize, and it's something that's helped me try and solve problems in my business hopefully before they've occurred. And that really, I think, is one of the keys to trying to scale a business, any business really. Mine happens to be a property investment group, but it could be anything, let's face it. Is trying to see those roadblocks before they happen, because one of the things that made a big impression on me years ago is a stat that I heard that the average letting agent manages about 90 properties in the UK, 90. So that was incredible to me. I thought, wow, why is it so small? How is it worthwhile? Of course, there's lots and lots of little one-person agencies that are managing a small book, and really they struggle to grow, or they do all the work themselves, and there's very few people out there who are great at all the things you need in a business, of course, apart from anything else. So my takeaway from this was try and see the roadblocks up front, try and work on those, and then try and get rid of them before you get to them. And that's been key. The last few years, it's been much more dictated by the macro environment and the constraints that's placed on certain parts of a growing property investment business, apart from anything else, which is why at the moment the financial pillar is so very important. So there are 4 pillars. We've now dealt with, in this year's videos, we've now already dealt with my first pillar, which is the supply side of things, or where you get your deals from effectively. And that obviously is a key part to any property investment business. And now we're on to the second pillar about finance. Now, lots of people say, look, if you get the deals and the money, then everything else is easy. Whereas I've always felt I'm not quite at home, don't feel quite comfortable with that comment, because ultimately you have to have good operations, good and strong operations, and it's not that easy to deliver property projects. It's really quite hard. If you're a builder developer, if you're a hands-on style character, it makes it an awful lot easier if that's where your edge is. But then, of course, you still have to deal with the other pillars of the business as well. So by no means is it a silver bullet. I've known many people set up or try and set up and own construction companies. I know very, very few who've been successful over the medium term. Construction's a tough game with low margins, generally speaking. And ultimately, you can do whatever you want in a way with a property investment group. You can nudge things here, there, and everywhere. I try and make each component part commercially viable. And a commercially viable construction company ultimately is going to have to charge me an awful lot more, certainly on the numbers that I've done, rather than me contracting things out apart from anything else. But you do need to operationalise stuff. And also, of course, you need to manage those assets effectively. Some of the big portfolio problems I've seen when I've consulted for people after Section 24 tax has caused them a problem has actually revealed the tax isn't truly really the problem. The problem is a lack of asset management, a lack of thinking that, oh, well, the agent's in charge of it, that's that. You can't manage property assets like that. It doesn't work. There's a job there that exists over the top of that, and you can call it what you want, keeping the agents honest, just making decisions that they're not paid for and not going to make about the strategy of your company. And that ultimately is the asset management piece, and that makes up the 4th pillar. But today's about the financial side of things, and it's been so very put to the fore in the last 18 months or so, because like in private equity, and that there is an element of private equity to what we do, of course, but just like in private equity, when money was 3% or cheaper, an awful lot was a lot easier. You just didn't have to worry. You could get money from the bank. It was very cheap, and there was headroom, there was cash flow. Now, this really changed sort of 2008, pre-2008. There wasn't a lot of cash flow. There was a lot of capital growth, and that's what people were chasing. And they were actually taking on loans where they were going to make a loss every month. And that was all fine and dandy until a massive recession came and a credit crunch came and all the rest of it. Although a lot of those people were still protected because they had base rate tracker loans, and those base rate trackers were tracking a base rate that was 0.5% for the best part of a decade, and actually ended up dropping lower during the pandemic apart from anything else. But finance is obviously key, right? And it has to form a core part of a property investment business. You do need to have a level of financial acuity. If you don't understand that sort of stuff, you've got to have someone great around you. Perhaps it's a JV partner. Perhaps it's a professional services person that you can trust that can translate that into language that you understand. Not everybody needs to understand how to put together a balance sheet or an income statement. You know, all of that stuff can be useful, but really it's not about that. It's about how do you interpret those things. And of course, like any business, it's also about cash flow, and that's what you really need to understand. So financial structure, there's lots of things I'm going to talk about. I'm going to talk about any money you've got now. I'm going to talk about when you're getting money from the bank. I'm going to talk about when you're using the vendor's assets as money. I'm going to talk about borrowing from the future. I'm going to talk about using other people's money, which is a controversial but essential topic to cover when we're talking about property. I'm going to talk about bridging finance and the likes. And I'm also going to talk about the vendor's money rather than the vendor's assets. So for those who haven't seen a 4 pillars video before, I split the pillars into 2 sides. There are 7 sub pillars on every topic, right? The first 3 are supposed to be more entry level, so anyone can do them, really. And then the second 4 are more advanced. You need some more thought, you need some more time, you need some more preparation, you might need some more experience. Not necessarily in property, in something else that you've done. If you're not going to get that experience, you might want to team up with someone who's got it, or you might well want to spend and invest quite a bit of time and potentially money in your education, which is a different subject altogether. So, financials and what to do, how to remain what I like to call financially attractive, because I do see it like that. It's almost like, in many ways, online these days, there's a dating element to it. The lender's got to see if you tick the boxes and they swipe right on you. There are obviously millions and millions and millions of pounds worth of mortgages and all the rest of it lent every day, and therefore a lot of lenders at the lower levels are only looking to tick boxes. So what are the boxes that you need to think about ticking? Well, you're going to need to think about having a perfect credit rating. If you haven't got one at the moment, you must make sure you don't miss any more payments. And you might have 12 months of problems, although it's not necessarily impossible to get mortgages, but you are going to pay a bit of a penalty for them. And at the moment, paying any more than the already particularly high rates is somewhat difficult. So it depends what position you're in. That might be another reason why you use a joint venture partner or work with someone else. As long as you're transparent about these things, it can make sense. But be financially attractive. Think about how you remain financially attractive, regardless of what your credit score says. And I've spent most of my professional life with my credit scores between somewhere between fair and good. You know, I'm not 999 in Experian. Why not? Because I've got debt, I've got leverage, and I use it. Now, I use it particularly intelligently. One of the things the credit ratings don't pick up, for example, is when you've got credit cards at 0% interest. That's been an amazing deal over the last 3 or 4 years because we've had significant inflation apart from anything else. So the debt at 0% has been eroded away beautifully for me by inflation. Best and cheapest debt I could get. But the credit rating agencies aren't measuring the rates when they're putting a rating together for you. They're measuring how much of it you've got. And if they don't like how much of it you've got, and if you don't know, using more than 25% of whatever credit you've got outstanding will knock your score down a little bit. Using over 90% of any one particular card that you've got will knock your score down a little bit. And again, these things, I wish they were more widely available and more widely talked about because they're useful things to know. But unsecured debt can be really, really useful in this game. Personal loans in 2021, one of the things I was saying during the pandemic was, what a great time to get a personal loan under 3%. Now, you have to bear in mind, you also have to think about things like interest as well as capital repayment in those situations. So whilst it might be a very low interest rate, the payments each month might be quite high because even if you're using something like a 7-year term, if you borrow 10k, the repayments are going to be at least 84 months in 7 years. So you've got to pay that 10k back over those 84 months before you get started. So divide 10k by 84 and you've got more than 100 quid a month of capital repayment to worry about before you're even thinking about the interest side of it. So that does need bearing in mind. But remaining financially attractive is the number one thing you need to do. And not only to the lenders who are going to score you, but also to other people, of course, because at some point during this journey, you're probably going to need external financing and probably equity or from somewhere else that isn't a standard vanilla buy-to-let lender. And if you do need that, it might be a joint venture partner who puts some money in and you say, look, I'm going to do all the legwork. I've got some experience. I've got some contacts. I've done some training, whatever it is. I'm an attractive proposition and people who've got lots of money like doers. They want to work with doers. They're watching online. They might not talk. They might not comment. They're unlikely to go out and advertise they've got lots of money. Otherwise, they're going to get 5,000 messages trying to scam them apart from anything else. But they are there. They're out there. They sometimes make contact with you or you can try and make contact with them. Of course, you need to be cognizant of things like Policy Statement 13.3 from the Financial Conduct Authority. There's lots of stuff you can and cannot get tied up in knots with this stuff or really get your knickers in a twist over. I would say just take a look at the brief, understand what you can and can't do, and understand that you want to be communicating with and working with high net worth and sophisticated investors. So where do you find them? Well, there'll be another video on that in the future. Thank you.